Welcome to Note Investing Made Easier, another edition. I'm so fortunate that I have you in my life, and you're spending some time here with the group. Thank you.
Well, the reason you feel that way is because I feel that way. If it's not mutual, then it's not good.
Yeah.
So
Absolutely.
thanks for having me back again to speak to the group.
Yeah, absolutely. A few things I just want to welcome everyone to Note Investing Made Easier, our weekly webinars that we're having. Please also check out some events that are going on. We have the Distressed Mortgage Expo in a few weeks in New Jersey, and Mahir and Mark Gold, they put on a wonderful expo. So please make sure you join that. And I'll be there as well, and I'm going to be one of the speakers there. And also, I'm picking my topic that I'm going to speak on, and I think it's going to be setting up a note business versus becoming a note investor. I think I'm going to go with that. And also, too, I'm running a special on my online course for sourcing and due diligence. So check that out. Mr. Howard 10 was also a guest, had a guest appearance there on that course, and a lot of cool stuff. We're also doing a training. I'm doing a training with Kathy J after the DME wraps up. So a lot of cool stuff. And I was just telling Mr. 10 that I've wrapped up writing on with my third book, and so just very blessed in that regard. So Mr. 10, let's start with what you and I last spoke about, and that is the road to success. How does it look?
Well, as I shared with you, one of the things I tell my kids, the road to success is always under construction. It's a journey. It's not the destination. But for me, the road to success in this space is going very well. A lot of it got a boost by being on your previous webinar, and I want to thank you for that. And so I'm hoping to share some of that with you today.
Yeah, no, I appreciate that. And Walner has checked in, and I know that you've connected with him, and he's just good people.
Yeah, both him and Katasi.
Mm-hmm.
When I first engaged with them, it became very clear to me the level at which I needed to start at. So we start at the lowest level and build the foundation for them. And last night I spoke to him, and he said he was just returning from a RIA meeting, and he said for the first time he started to see things that he didn't understand. He was starting to understand that, and that to me that's the success. Excuse me.
Well, what's interesting is that when I started buying properties a while back, it was 10 years ago, and I ran into a rehabber that rehabs on a very high level, multi-million-dollar fund and everything else. And he pretty much has a price in mind before he steps foot in the property. So he has a per square foot price he works with, and he does all his calculations, and he'll go into a home and just, within 30 minutes, here's my offer, take it or leave it kind of thing. And I always found that interesting. And at the time I was like, well, how can this guy do that, without going and doing the mold test and checking the foundation for cracks and, all these other things. And what I found over time is you develop that gut sense, and, you can go in and I can meet people, and I can tell within a few minutes, I just feel it. I'm like, this person's going to make it. This person's going to do it if they stay committed, or, this person may have trouble in a certain way. So I feel good with Walner and Katasi. I feel like, they have what it takes.
They're very bright. They're extremely bright.
Yeah. So let's jump into things here. You have a pretty long background, and in computer science, and being a stay-at-home father, and raising two Eagle Scouts, and starting a what was it, rehab company that you owned and sold.
Yes.
And
Yes, I did.
I think those, what always strikes me, what I'm looking for when someone says they have this company, whether it's the rehab company or landlording or what have you, I always look for how they exited out of that company. That tells me a lot about that person. So when you put on your bio that you sold that company, it told me that you had systems in place, that you had a whole production flow, and you built it up to be a profitable company by which it could be sold for money. So you treated it as a business, is what I'm saying.
Yes. And in today's digital world is it's the list that you have. It's the client list that you have. That is more than 60% of the value of your business. Most people don't know that. I discovered that back in the 2000s. I was working as a research analyst for a valuation company. And Malcolm Forbes, which is the father of Steve Forbes of Forbes magazine, passed away. And we had the contract to value the company because he died intestate. And when I discovered that 65% of the value of this company was the list that he puts out, 10 richest men, 100 richest, 10 best place to live, I was dumbfounded to find out that this list, these lists are called databases, because Google and Amazon and Facebook, their entire value is those databases. That's it. Yeah. So the biggest value to your business right now is all those emails that you have and all those connections that you have on Facebook. That is the biggest value your business is, and I know how to value those things.
No, that's wonderful. Yeah, what the business behind a Facebook group, if you will, is that you can grow people you have connections with within a space, and just set parameters so that it's clean, and there's a good flow to it.
Yeah.
Versus in a CRM system. And what I find, though, is people with the CRM system, they're working the numbers game, and they're just trying to load it up with as many people as possible. But I assume you have a different philosophy on that.
In fact, when you texted me to get on, I said, give me 5 more minutes. I was actually on a conference call teaching someone how to use LinkedIn and how I use LinkedIn. I'm new to the social media space because I studied it for 2.5 years. And when I opened up my LinkedIn account, as you know, if you don't have 500 connections, you really are fluttering out there. And within 2.5 months, I was close to 1,000. And my wife said, "It took me 2.5 years. I can't even I just got over 500. How did you do it?" And I showed her, and she went right over.
No, that's great. And even like technology like Zoom, like what we're talking on now, I do a lot of training sessions on Zoom where we go and share the screen and we mind map and do some other cool things. So yeah, technology should very much be a part of your business practice. But let's jump into things here.
Sure.
So Howard 10, he is the man. If you're looking for money to buy non-performing note portfolios. Is that correct?
Yes, I am a private lender and teaching people how to do it. But the model that we use when it comes to the note people is we're looking at it from a business perspective. Let's just look at any business. Every business needs access to capital. So they start out by putting in the capital that they have. They run up their credit cards. They do whatever they have until the bank comes and says, "Okay, we'll give you a line of credit." And then you try to get favorable terms. And as the business grow and the revenues are coming in, you get access to capital. No business can succeed today without access to capital, which means you have to know where to get it. And when you are raising capital, you're selling one of two things. You're either selling equity or you're selling debt. So if I come to you and it says, "Hey, Martin, I have a business. It's doing very well. I need some capital. Do you want to invest in my company? Um, I'll give you some shares." I've just sold you equity. Or if you lend me some money, I can pay you back. I just sold you some debt. So the bottom line is that you have to understand the consequences of making those decisions. The most expensive way to raise money is actually equity, because you look at a basic joint venture, you give away 50% of your profit.
Yeah.
But so if you do a loan, you might give away 10-15% of the profit in cost. But you better understand how to manage that debt. Otherwise, you could run yourself into problems. And
Let's talk the flip
yeah.
side, because I can tell you that there's people that would choose the equity raise option because they don't believe in the returns that they're professing.
Well, here is the problem. I agree with you, or even if, let's say they believe in it, and yes, say they can, they are operating it from a mindset that if I can tell them how profitable this thing is, people just throw money at me. And so the higher the rate of the return they can tell them they can get, the more they think it's easier to raise the money. But the only strategy that I have found that in any business, any investment ventures that lose you money is the greed strategy. And so making all of these big promises is appealing to the greed of the person you're trying to put the money in. And then you set the expectations way out of whack, and now you set yourself up for failure.
Okay, so who is the person that is putting money out? Who's the passive person? Like, what's their makeup? If the makeup of the expert is, this greed factor, who's the person on the other end?
No, the greed factor is on both sides. If I go to a local RIO or a real estate meetup or a note investment conference and everything, and I say to them, if you work with me and you lend the money out, you can make 8 to 10%. They don't get excited by that. They're there to make the 30, 50, 60%. And as Walner and Katase will tell you, I have shown them that that is really not that easy to make when you factor in time. And they're learning things now that they never, because they have taken many different exposure to different things, and they're going like, wow, I didn't realize this. I didn't realize that, because I said you were thinking like an investor, and you're trying to get the biggest rate of return. You're not thinking like a lender. But the question I always ask people is, would you invest in something that you would never lend money to? And the obvious question is no. Well, wouldn't it be better if you know how to lend? And using the mindset of a lender, you can determine whether or not that is a venture worth investing in, because you know that it's going to work, and now you're willing to take the additional risk to make the additional return. And that's what I'm trying to teach them. And so, to answer your question, if it's not one person is the greed, it's both sides, and that's when everything falls apart. Oh, you get in there, we're going to sell it for this, we're going to make 30%. And the person says 30%. Yeah, I mean, you're only making like what? Less than 2% in the bank. Why would you do this? And and they get carried away. But they don't ever look at how do we get to this 30%? And that's,
So understanding the roadmap
yes,
by which a 30% return on a portfolio is derived. That's important for clarity for everyone, for both sides.
correct. The thing that I keep drumming out there, and I keep asking the question, how many of the people in the audience are private lenders? And everyone who is in the note business is a private lender, because a private lender is a person who uses this private money and lend it to somebody else. The moment I buy a note from you, right, it's now my money that's now being lent to the homeowner. The rules are a little different, that you gotta, but it's still the same thing. You have risked your private money and you've lent it, because as you look at the tapes, and one of the things on the tape is it says, it was taken out on a 30-year mortgage, and there's still 200 payments left. You're buying those 200 payments.
Mm-hmm.
You are buying those 200 payments.
Yeah, you've put the money out to buy the discounted note, and
it's 1 second. Sorry about that. Let me turn it off.
No problem. I have a comment from Ellis, my West Coast brother.
Okay.
And he says, with non-performing notes, sometimes it's a lack of predictable cash flow that limits debt versus JV. So your thoughts on that? So it's, whereas you have a debt structure and you're going to be paying back on an ongoing basis, that may really crush you if you have some down months. But if it's a JV where everyone's in it for the upside, then everyone just needs to hold on.
And he's correct. He's absolutely correct. So because the lack of cash flow, because you have to pay the debt. But ask him, has he ever heard of a concept called negative amortization?
Well, you can ask. You just asked him.
Okay.
Hey, Dwayne, you just asked him. So we'll wait. We'll wait to hear from Ellis. So this concept is not well understood or generally accepted, in that when you note invest, you are a private lender.
Exactly. You prove it to me where you're not.
And so given that characterization, that almost leads to what? More questions in terms of how you need to view yourself or how you need to set up your business model?
Correct.
Okay. So tell me a few things on that.
Well, the first thing that I look at is, as a private lender to either the note industry or the fix and flipper or the local guy down the road who is running a dry cleaning store and asks me to lend him some money, and I'm going to put up his equipment as a security, or I buy the receivables, and I've done this, bought receivables from companies in Peru. I make 25% a month doing that. The bottom line is, when you're setting up your business, what you have to understand is, from the note investor side, is you better calculate upfront what the payments are going to look like. Because remember, the note you're holding, that payment, when it was originated, that individual can't make those payments anymore. Yeah. This is why they stopped making those payments. So you have to figure out the time value of money before to make your bids. And it's always shocking to me that people actually don't do this calculus. And so when they come to borrow money from me, once they fix the notes or they want to do that, I ask them, let me see the collateral files. And I look at the collateral files the very same way that they did when they originally bought it. Remember, I always said people think I don't understand the note business. I do. That's why I can lend to it.
Mhm.
Yeah.
Well, you're also one of the few players that lends debt to non-performing note portfolio buys.
Correct.
Why is that?
Because first of all, it is not as simple as here's the money, go buy those. It could be, someone, if someone comes to me and I was never ever owned a note before and asks me, I understand you, Lynn, I want to buy this portfolio of non-performers. What would you lend me? Right off the bat, I realized I'm dealing with a completely inexperienced person. So those notes are not necessarily going to be the collateral. I would say, well, what other collateral you have? And I'll hold that collateral until I understand what you're doing.
So if they give you real estate, you put a lien on the property.
Correct.
That.
It's called cross collateralization. Another way to do it is if you look at the model of a fix and flip, guy comes and he secures a contract. He comes to you and he says, "I'd like to borrow some money. I want to borrow. The after repair value is $100,000. I want to borrow $70,000." I said, "What are you going to use the $70,000 for?" "Well, I need to close the deal, and then I need to rehab the kitchen, put on new flooring, and then I'm going to market it and everything." If I'm going to give him this, I am not going to say, "Oh yeah, okay, sure, here's the 70 grand." I'm going to control the draw. I'm going to be controlling everything along the line. Very few people will give you 100% of the money to acquire the deal. What they may do is said, "Okay, you put 10% down, we'll put the rest in to acquire the deal." And the reason why they do that is because they want to make certain that they can properly collateralize the material before the asset before moving forward. And then they start to control you. You're going to do the batch. I'm not going to give you any more money until I see this. I'm not going to do it until I see this and until I see this. So the private lender or the lender is always into control.
Well, okay, so let's just stop there for a minute. So what are some of your due diligence items when you're underwriting a transaction?
Well, the first thing that I do is I ask, what is the use of the proceed? Tell me what you're going to do. This is so important. And the reason it's so important is, remember, at some point, he's going to have to pay you back. So am I financing a lame brain scheme? Does the guy know what he's really doing? Is he really whacked out there? That's one of the very first thing that I want to know. Because I'm getting, remember I said, I bet on the jockey, not the horse.
Well, I just laughing because I'm thinking of a time I know someone who bought a $25,000 food cart to go place it in a downtown area, only to find he couldn't get a permit to place it in the downtown area.
There you go.
There
you go. There you go. Because these are the things that can happen. The second thing I want to know, who is the borrower? If you come to me and ask me to lend you the money, the automatic assumption is Martin is the borrower. Well, I don't lend to individuals. I lend to entities. So the question is this a newly formed entity? Does this and in fact, I use this example. I had someone who came to me and asked to borrow money, and I said, "Who's the entity?" This is my LLC. I said, "Okay, send me the articles of incorporation and the LLC agreement so I can take a look at it, and your financials." And the guy says, "Well, the problem is we haven't done the tax return yet. I'm kind of behind." I said, "How much?" He says, 2 years. So I said, "So let me get this right. the IRS is the most powerful institution in the country, and you're not afraid of paying them. You don't pay them. You don't care about that. What's going to happen when I lend you the money? And right off the bat, what you're seeing is the willingness to pay. Willingness, is what are you dealing with right now? So my due diligence has a lot to do with who I'm talking to. And most of them are not even aware that I'm actually doing the due diligence on them. Because the bottom line is, if things go wrong, are they going to be honorable and walk away, or are they going to fight me and cause me a lot of problems?
Because they're showing you, they're giving you the collateral file for the tape. They're walking you through, the returns, how they're going to make their money, what the time frame is. However, you care about that, but you also care about the property that you're going to cross collateralize and hold, hold until the money's paid back.
Yeah, I mean, I have lent money on purchasing a non-performing seconds, and but the person who is buying it has a history and a reputation of being very good in this place, and even then he put up temporarily a cross collateralization, but the agreements are such that eventually these non-performers are going to become the collateral. Because you have to understand, you do not own it, so you can't put it up as collateral to purchase.
Yeah. So when you look at what someone has to put up in terms of collateral, that almost gives you a roadmap for how successful they've been in business in general. Is that correct?
Yeah, correct. Because if are you going to lend some money to somebody who has never done something before? I've never flipped a house before, but can you lend me money? I'm going to do this. When I loaned out money to some people to do they use it and then lend out to the construction industry. I asked for a meeting, and we went into the meeting, and they start telling me how I said, stop. Tell me the worst case scenario where you lose money, and tell me what you did. And they said, well, here's what happened. We really didn't lose money, but it took us this, and here's what we had to do. And what we done, I just took out my checkbook, draw the check, and handed it to them. And they looked at me and they went, that's strange. I said, I just wanted to know, when the shit hits the fan, what are you going to do? You're going to run, or you're going to let me, excuse my line, holding the bags? It tells me you have a system in place. It tells me you've gone through that, and we can work things out, because the fact of the matter is, nothing ever goes the way we plan.
Yeah. Yeah. And your end game is not to take back the collateral that's placed and try to make do. I mean, you want the willingness for the borrower to pay you back, for them to work their way through things so they pay you back.
Right. And what you don't want is, you don't want a person who quits. Because if he can work his way out of it, and we see some success, and he wants to go again, and this time it looks a little bit better, he becomes better. I'm sure everyone on this call who does note investing can tell you their horror story. They just hide it from everybody because nobody wants to hear it.
Yeah.
Well,
tell us, on the topic of worst story, do you have a worst story?
Yes.
All right. I'd like to hear. Do you mind sharing?
Oh, I don't have a problem sharing.
All right.
It was the first note that I bought. It was in Texas. And what happened is, it was non-performing. We bought it for 55 cents on the dollar first. And it was about $65,000. Mm-hmm. And we bought it. No sooner we bought it, the homeowner died. Mm. Okay. So the homeowner died, and so of course you know what that means. It gets all messed up in the thing there. You can't start the foreclosure process. So we appealed to the courts and whatever, and fortunately for us, they only had one beneficiary, and so they're working through all of that, and then the beneficiary dies.
Whoa.
And he didn't have a will.
Wow.
And the horror, and that's not the horror story. Because of that short thing, nobody actually went into the house and cleaned out the house. They had just put a lock on it and everything, and they turn off the electricity. So I'm going to tell you, if you really want to know what happens, turn off your electricity, go away for 2-3 months, and come back, and then see what the house looks like. Well, all the food and everything in the refrigerator and the plants not only die, but they start growing mold, and it spread out, and it came out of the refrigerator, up the wall, in the back. I mean, the whole place just got real bad. And so what I did was I sold the property, because I had to take the property back now. I sold the property for $68,000. I ended up losing $2,000. That's my horror story.
Yeah, that's not bad. I mean, learning curve wise and everything, I'm sure it was much worse as you were going through it.
Yeah, well, one of the things I learned in life is how to check my emotions. I'm very much very calm. The worst thing, people always say, you're the person who will, when the nuclear bomb drops, you're the guy who's going to be leading everyone, because I just block everything out. I just move forward. I shut my emotions, get shut down. I'm just like that, you know.
That's wonderful. Yeah,
Right.
it's a good attribute to have. I'm pretty even. I'm pretty even, tempered too. I'm pretty low key when it comes to dealing with situations. So that's a good. I know that's a quality that serves well. I think though some things, and this kind of get off on a tangent, and then I want to get back to Ellis wrote a comment here. Where it doesn't serve us well is we don't have the cheerleader, presence about us to rally the troops and everything, because
right.
we can't turn it on, so to speak.
Yeah.
But yeah, so let's move into how to set up a proper joint venture. So you have what is it you kind of see out there in the note space now in terms of joint ventures?
Well, I'm going to take half a step back, because the big elephant in the room is the Securities Commission. So when people go to joint ventures because they don't want to go through the expense of a PPM. So what they're trying to do is get around the cost. And so what they look at is, okay, we're dealing with real estate, so what we'll do is we'll just set it up as a joint venture, and we won't it won't be a security. Understand that the 1946 ruling, which is referred to as the Howey test, is what determines what is a security. Yeah, try to hide the That's okay. You're trying to fix and flip your home while we're talking.
Actually, we're moving in a few months, so we're getting the house prepped. Go ahead.
Right. And what if you read the rules carefully? What you really see is that what the courts are looking at is not the actual asset. It is the agreement. It is the agreement that is determined to be the actual security. So
let's just stop here, because that's an important, key point you're making here. So what a lot of people in the note space, and granted, there's a lot of people coming in, even experts, a lot of people in this space they don't know. So, I mean, this is kind of a learning, sharing thing here. What you're saying is a lot of people go into the joint venture thinking that the security is the home, is the end property that's being,
It's the asset.
it's the asset, and
That's
you're
right.
saying no, that's not the case.
That's not what the courts are looking at. What the
Okay.
courts are looking at is the agreement. It's the
The
agreement.
the joint venture agreement.
Exactly.
Okay. And what are
And that,
they scrutinizing on that?
okay, there are there are four tests. That, oh, is money involved? And the answer is yes. They have, and other courts have since replaced the word money with money or assets. So I could only, if I owned a non-performing note and I come to you and I said, let's do a joint venture and I'll put the note in, that is also considered to be money. Okay.
Hmm.
Is there a reasonable expectation to make profit? Of course, you wouldn't do it if you didn't expect. The third one is the money communal? Is there more than one person in there? And the answer is, chances are yes. Even though your expertise, you didn't put money in, you might put expertise in, or you might just, even if you put $1 in, the other, the promoter. And here's the last one. The last one is the profitability of this is skewed to to one person? Is it, the promoter? The courts have then gone back and look at certain things and basically applied the ruling of really how much control does the investor of each person has? Are they actively involved? Do they have any control in the say? And the reason this came about was that the promoters, the people who are trying to raise money, thought they could get around it by just saying, okay, we'll just sell you an interest in something, right? And you don't have to, don't tell me anything, don't control me anything. And so the court says, no, it doesn't work that way. So the problem that you see is in most of these joint ventures is that when you look at the agreement, there's no way of spelling out who does what, who's responsible for what. But it's not just, okay, Martin, you're going to do the accounting and you're going to do the books. Well, I don't know how to do the books. Doesn't matter. We'll just put that there. No, you have to be able to know how to do the books. You really have to be able to do what it says you're doing there. And you do have to do it. So because of that, guess what you can't get into a joint venture with and get around the securities with? Your IRA.
Your what?
Your IRA. You can't use IRAs to do this.
Yeah, so it's very different with the IRA, and I know that's actually strategic. That's a strategy of some investors in the real estate side as well as note side to reach out to people who have self-directed IRAs for capital.
Getting there because the moment they do anything, they have created a prohibitive transaction. And the moment they don't do anything, they have now violated securities. You see the trap you get into when you do those two things, and that is, I'm not a lawyer, and I'm not giving legal advice. What I am giving you is questions to go ask your securities lawyer. As I always tell people, 50% of the cost of every legal bill is the lawyer trying to figure out what are you trying to do, and he's trying to read your mind. If you know exactly what you're trying to do, you know what it is you want to do, it's going to cost you less money because you can tell them, this is what I want to do. So that being said, again, you have to go and get and verify everything that I tell you, because I'm not a lawyer and I'm not offering you legal advice. I'm just saying, look at it from a common sense. If the securities angle is that to not be a security in a joint venture, they both parties have to be equally involved and equally controlling everything. That being said, how can you use your IRA to do this? You can't, because then it becomes prohibitive transaction. So that being said, I realize at this moment, the boom, 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 boom you're hearing in the background are people's IRAs being blown up all across the country.
Yeah, and well, so, but I think the the real benefit to us having this conversation now is that if you are someone that has joint venture agreements or you're setting up joint venture agreements, you should have a good SEC attorney that you're reviewing everything with. And if you're not, I mean, you need to find one and just start moving in the direction where you're going to minimize your risk.
Okay, that is a very good advice. However, you may not necessarily need to have a securities attorney to look at a joint venture if certain conditions exist. If we have established relationships and we have equal skill sets and understanding, and let's say you and I get into it together, given your background, my background, and our thing, and I said, you know what? You called me up and you said, would you joint venture with me on this particular tip? I'll do all the due diligence and stuff. Here's what I need you to do. I need you to do the marketing. I need you to do the servicing, make certain all of that. And your skill set in negotiating, I would like you to talk to the homeowner. And in a structure like that, there's no need to go to a securities person because we have an established relationship. We both have certain level of understanding. You know why the Securities Commission set the accredited investor at the level that they do, 150,000?
We've had this discussion, and I've taken the opposite view on this, but what you're saying is probably more correct.
The simple reason is the simple understanding is if they can put out 150,000, they have enough money to sue your butt to make things right.
What I say is they have enough money to afford losing some money, but it's the opposite.
They can come after you. Yes.
Yeah.
The Securities Commission is more interested in protecting the small guy who doesn't have the sophistication and can easily be wooed. A guy who can put that in, have some level of sophistication. Nobody can afford to lose 150. Maybe you, Martin, but that's why I said no. Yeah.
No.
They can hire the lawyers. They can hire everything. They have the means. They're trying to protect mama, grandma, grandpa, retired, and can't afford to lose a dime because they're just trying to, and so they're protecting those people.
Yeah, and I say this because I have people reach out to me weekly. They read my book and they want to invest and everything else. Just be conscious of the people you're taking money from, because some of the folks, they're much older in age. I had a lady, she said she's just retiring. She only has 35K. She wanted to invest with me, and I said no. And but I know that there's folks out there that would take her money in a heartbeat.
Yeah, one of the things in the securities world we use is something called the prudent man rule. Would a prudent man, given the situation, do this? And to take the only money they have and put it in one investment, it's not a prudent move.
Yeah.
It's just not prudent. Yeah. And so that's why we do what that's why the Securities Commission is there to make these things don't happen, because it doesn't matter how sure you think something's going to happen. It's going to happen, whether you think it's not going to happen or not. So you have to edge against that.
Yeah. And so let me shift gears a little bit here, because you lend to note investors that are buying non-performing note tapes.
Correct.
And so what are some successful attributes you see of those note investors?
Well, I think the biggest thing that I see is like what I see one of your friends, Kathy, has, is they have systems in place. They run things through the system, and they stick to their systems. Because the bottom line is that
You know,
if you
Kathy's
don't,
on. She just joined us, right?
oh, hello,
Talking about
Kathy.
Kathy J, right?
Yes, the fact that she is not making her decisions based upon her feelings. She's throwing numbers in there, and it's coming back to her, and she's saying, okay, here are the scenarios. You know, what people don't seem to understand, a spreadsheet is nothing more than a what if tool. What if, what if, what if, what if, what if. And when and Walner is on, and he's seen me use time value money and do the what ifs with that. Okay. In fact, one of the things we did just recently, I asked him to provide me some of the information on the tape, and what we discovered was the reported UPB was off. And I said, how many people here are making decisions on the UPB, not realizing these tapes can be altered?
Yeah. Yeah. No, we had we looked at a very large tape in July, and I think there was Allie, if you're on here, you can know better. And Sean, you also would know too. I think like 20% of the UPBs were incorrectly reported.
Yes.
So I mean, yeah, I mean, if you're going to use bad numbers, you're going to have, the garbage
So
coming out.
yeah, so just think about it. If you're buying 50 cents if you're buying 50 cents on you're bidding 50 cents on the dollar, and it is off by 10 grand, you've just paid 5 grand more than you should pay.
Yeah. And so it's on the buyer to know this.
Yes. And if and I will say that the seller, even if even if he's not doing any malfeasance, it could just be a mistake.
Mm-hmm.
It could just be a mistake. Or
Yeah.
we all know this is a very honest industry. They honestly play with those tapes. So I, walking through with Walner right now, I am showing them how to verify all those numbers, because the bottom line is most people, the first thing they do is they go check the value of the property. I said, no, let's make certain the numbers you're seeing on the tape are actually true.
So you're not only, and I know the answer to this already, you're not only lending on non-performing note portfolio tapes, but you are also helping train and bring up some folks too in the industry to do what you do.
Yes.
And
In
what's your
fact,
reasoning behind that?
first of all, I hate people being taken advantage of. And a lot of times it's just plain not knowing. And when you get into the note industry, you must have to understand the real impact of the time value of money. Okay.
Can you just explain that high level time value of money concept?
Okay. When a bank lends you money, every day that goes by, there is you're renting out your money. There is a accumulated interest. Most people don't know that. There's a daily interest that accumulates every single day the loan is out there, and then it gets added and compounded on a monthly basis. Okay. And in fact, I'll give you an example of a powerful of time value of money. Somebody sold a partial, and because it was unseasoned, the person says, I'll tell you what, give me 70% of the money, and then once it becomes seasoned, um, we will give you the rest of the money, which was about 12 months later. And he calculated when he set the price to sell the partial, he calculated it that the person was making 11%. When you took the transaction and you put it into time value, you realize the person who bought the partial was making 25%. And now a guy came to me and wanted to sell me a partial. He wanted to give me at 11.5%. And I said, and I knew he needed the money. I said, you know what? Okay, I'll do it, but I need 4 more payments. And he said, no, no problem, here it is. And he gave it to me. And when you put it into time value, what happened is it bumps the rate from 11.5 to just over 12.5. And he didn't even know that happened. Mm-hmm. I knew it happened because I constructed that move. Okay. And there are many different things you can do to understand a lot of that. When you buy a non-performing tape, you're not going to get a cash flow till when? 9-12 months down the road?
Yeah.
And then what cash flow is that going to look like? And by this time you start doing that and you go back, you find that they're not making 30%. They might only be making 13%.
Well, what's interesting is, and you bring up kind of another topic, and that is this is probably a whole other webinar, but it is how to price notes. I see, a lot of people, they want to price it based on what they feel the market going range should be. And I've always priced it where after I do my due diligence, I say, well, what's my exit strategy look like? And then given what I'm anticipating in terms of a return, then I say, well, this is what I'm willing to pay to make the return that I need to make. And I let that exit strategy / projection determine what I'm going to pay for the asset.
Correct.
And then on the flip side, because I've done, I have both bought and sold reperforming notes. So I think that some things that I've seen some folks do is they still look at that cents on the dollar model for when they sell their reperformer. And that's when they lose. They need to be looking at what return they're giving the investor.
When you sell a performing note, okay, you're selling all the payments, right?
Mm-hmm.
The only difference between that and what is the difference between that and a partial? The difference between that and a partial is time.
Yeah.
Because after 60 payments, those payments are of less value, and they're of more risk. Because when they buy the full note over 60 payments, you must remember the person that is making the payment has a history. And the chances are it's better than 60%. It's gonna become a non-performer again.
Mm. So it's not that when they're making payments into those 60 payments, the borrower's making payments into the 60 payments, they're reducing the risk for both the partial buyer and the note holder, because they're showing the seasoning, but also that they're just showing performance. I don't know. You would say, and the chances of it refinancing at some point is greater and everything else. You kind of look at it like the likelihood increases that they're going to become.
What we know statistically is that mortgages get refinanced every 38 months, between 38 months and 12/7 84. What I call is a culminating event. Something is going to happen that change what's going on right now. Either they sell the house, they refinance, they stop paying, or whatever. Where I found that information was the first year when I was in this industry, and I was at Paper Source, and I saw these feelings of servicing company, and I walked up to them and I asked them this question: when you get a performing note, what statistically, can you tell me when the note fails and start? And that's where I draw the information from. And I start calling them up and I ask them. And what I discover statistically is where the risk was. Because I was looking to buy partials. So if I knew that if I buy 60 payments, the odds are on an average, if I bought 100 of them, on an average, somewhere around 38 months, something's going to happen. Now that means they could refinance and pay me out, which is a good thing, right? And or I could do such and such. And of course, when you do partial, when they pay you out, you get the unpaid balance. So what I did was I created a contract to buy the payments. If I buy 60 payments from you, it means you owe me 60 payments. So if they refinance 6 months down the road, okay, where's my other 55 payments? I construct my partials like leases, not like loans. And that's another story. But the bottom line is you can actually do partials for less money because
So leases being that the principal and interest over
when you
60 payments needs to be paid back in full upon refinance.
you're buying payments. I'm buying 60 payments, whether you pay me over 60 months or you pay over 6 months. I've just bought 60 payments.
Yeah.
And what has happened is all these experts and I drew up the contract. And after a while, they eventually found out they don't want to sell me any partials. They don't want to sell me any partials.
Because of why?
Because they don't want to pay me the 60 payments. What they want to do is work on my money while they're trying to sell the note.
Knowing that whether they know it or not, something may happen at the 38-month point.
They did not know. Most of them did not know that.
And they don't want to be on the hook for the additional 12 payments.
Correct. They have to, yeah, they have to pay thing there. This is financing. I mean, I'm shocked how little people understand financing in this business, and they're doing this. It amazed me. And some of them have been doing it for, if I start calling names, you would be shocked.
Yeah.
But that's not my business. I'm not going to call them out for whatever it is. The bottom line is, if you're in this business, time is everything. Time is money. And every day they don't pay you, it's costing you money, because it's now costing you in effort and time and lost opportunities. You got to think like the bank. This is the way the bank thinks.
Yeah, the lost opportunity is where else they could have placed their money.
Right. There's a reason they sell it to you off at 50 cents on the dollar, because when they look at the effort and the time and the cost, it's faster for me to just get rid of it. Move on.
Yeah, and that's like the same line of thinking, with I don't know, Robert Kiyosaki, that says, don't have dead money equity sitting in your primary residence. You should be putting that money to work, whether you do a HELOC and invest in real estate with the money or something like that. It's that opportunity cost can be a killer.
The thing that people don't understand is when they take the advice, when Kiyosaki says that, he is right. But what he doesn't expand enough is how to manage the debt and understand the debt and how it's impacting everything. If you're a lender, if you're a true lender and you understand what time value of money is, you will understand not to taking a home equity to do that is called leverage.
Yeah.
It's called leveraging. And I always tell people, leverage cuts both ways. It just looks like it cuts deeper on the way down.
So I think the main takeaway, and we have to wrap up here because we're at the end, but I think the main takeaway is that if you're gonna be a lender, if you're gonna be a private lender, whether you're a note investor or you're lending to note investors, you need to learn how to be a lender.
Correct. But you can
the understanding how finance works, understanding the due diligence process where you're vetting the borrower, you're vetting the note deal, but you're vetting the borrower, their ability to pay, what their cross collateral looks like, and you're putting them through an underwriting process as if a bank would do, put someone through an underwriting process.
Yeah, I mean, would you prefer to make 12% with trouble, or would you like to make 8% with no trouble?
Yeah, 8% with no trouble.
Exactly.
Yeah.
And one of the things that I am trying to teach Walner and Kadasi is to really understand the probabilities of getting an uninterrupted stream of income. And understanding this, if you look at something that and you said, I would lend to this, but this is such a damn good deal. What I could do is negotiate with the guy, and this will answer Ellis's question that says, I'll tell you what, the payment is 250, but you can't make 250. But if you make $50, a month to me, I will amortize the other, capitalize the other 200 until you make this work, because I know the venture is so solid that I'm going to get my money back. And Ellis can borrow because he can afford the 50.
Yeah.
He can't afford the 250, but he can afford the 50.
Yeah.
And as a lender, you can structure those loans.
Mm-hmm. Yeah. So I think in ending, also just another closing statement is to, just be real conscientious of who you're spending time with, who's in your inner circle, who are you staying tight with. I can run down the list here of people, Kathy J, Mark, Allie, Sean, on and on. And, Howard, you hear, these are the people that I stay close to, because these are the people that have knowledge. They want to do business the right way. And, they're always learning and growing. No one here knows everything, but it's the people that are trying to know as much as possible so that they can hone their business skills and practice. That's who I want to surround myself with. So Mr. Howard Ten, thank you. If you would please place your information on the comment section, how they can reach out to you. Anything you want to talk about. I think you're only picking up a few students, but if you want to put something out there on that, whatever the case. I know last time some folks punched you up, so
yeah, you mean go on Facebook and just put my information out there?
Yeah. Put
Okay,
whatever
on the
information
comment.
you want on there, and people can reach out to you directly.
Yeah. Well, it was fun. I want to thank you for having me again. I want to thank the people who were on this to listen. I hope I did add value. At the end of the day, and Walner can hopefully attest to this, my goal is to try to make you successful by understanding some basic principles. And by making you successful, you'll make me successful. It just goes hand in hand.
Doesn't it?
Yeah.
That couldn't be more of a true statement there.
Yeah.
And Warren and Michelle, thanks for joining us as well. Mark, Dwayne, thank you, brother. And we wish everyone the best. And until next time, we thank you all, and God bless.
Okay. Bye.